If you're working in accounting and you have any related companies that do transactions between each other, this is one of the most complicated topics. Not only are transactions difficult to record, but you need to know how to eliminate them on consolidation. This presentation is going to cover those types of topics for people that need to understand it. So the first step on recording an intercompany transaction and doing consolidations is to understand the entity structure. So I've put just a summary here of something that could be an entity structure. So you have one parent company, and perhaps that company is the only one you need to do consolidated financial statements for. And then under the parent company, they have subcompany, two of them. One I called it just subcompany 2 and subcompany 5. Those are the two right underneath the parent. And then under subcompany 2, they own two other companies, sub 3 and sub 4. And then under sub 5, they have 6 and 7. So numbering is just for illustration because I didn't want to put names in here. Now, when you're consolidating, what you're basically doing is taking all of the results of the companies underneath the parent and adding them together with the parent. What that means is that as long as you own 100%, for example, if the parent company had a bank account with 100 and one of the subs had a bank account with 100, you would show on the consolidated statements $200. So that's basically how consolidation works. Now, when you do transactions between the companies, that is common because maybe the parent company has one bank account and they're going to pay on behalf of a sub-company. Other times, a sub-company might loan to the parent or the other way around. So in this presentation, what we're going to do is go through some specific examples of transactions and how they should be accounted for in both companies' records. Now that we want to do some transactions, we need to look at the entity structure in question. So in this case, we have the parent company ECI, and underneath there, we have two that I'm showing on the chart, Exotic Key and GBO. And under Exotic Key, we have GBB and SPC. Names and types of companies doesn't really matter for this example, but I'm going to explain why we have intercompany transactions, and then we'll go through how we do the entries. In this case, we do them in QuickBooks, but it could be in any accounting system. So the first example I'm going to go through would be where ECI, the parent company, has a US dollar bank account and they're paying commission expense on behalf of Exotic Key. This happens for many different reasons in different companies. It could be that the subcompany doesn't have that currency of a bank account. It could be that that company just doesn't take deposits in, so doesn't have the cash. Many different types of examples of why this could happen. The second one is an example where GBO, which is the subcompany 5 there, has a credit card machine, and many of the other entities do not. So GBO could get a deposit on behalf of GBB, which is the sub 3. So that's the next one we'll cover. And then number 3, we're going to do where GBO is charging rent to SPC. And this is a little bit different because it's going to be a revenue of one company and an expense in the other. And then the last one I want to do is where GBO is receiving a deposit, and it's actually for SPC, for gym fees. So those are the 4 that I want to go through. So as I mentioned, example 1 is where ECI is paying an expense on behalf of Exotic Key. So we need to look at the accounting in each separate legal entity. So on ECI's books, they're going to prepare a bill, but that bill is not going to be to the expense account commission because it's not ECI's commission. It's actually Exotic Key's commission. So if you look at the Exotic Key chart, like the second box, you could see that bill is debited to commission expense. Whereas the one in ECI, you could see the orange text there for Exotic Key, and that's going to be an Exotic Key intercompany receivable. And because they've paid on behalf of Exotic Key really owes them money, so that's why it's a receivable. Now, the accounts payable side happens automatically when you're doing a bill in QuickBooks. And then, of course, you can pay it just like you normally do. So when you go into the payment to pay a bill, it's obviously going to take it out of accounts payable and take it out of, in this case, Chase Bank. So on the ECI side, it's very simple. You do the bill, or sometimes it's called an invoice, depending on your system, and then you record the payment like you normally would. Now, getting into Exotic Key, it's a bit different. Now, we're going to, like I said, code the bill like you would with the regular expense. So we debit commission expense, credit AP, which again happens automatically when you're doing a bill. But you cannot record a payment for this one because the payment was already made through ECI. And this is an error I've seen made commonly, is that a lot of people think, okay, well, I need to record the payment to get it out of the payable, and they just don't choose a bank account. Well, that makes no sense at all, and hopefully your accounting system does not allow you to do that. So in this case, to get rid of the AP in Exotic Key, what we are doing instead is a credit memo. So the credit memo is going to take it out of AP, and we're going to credit ECI, intercompany payable. It means Exotic Key actually owes ECI money because ECI paid an expense on their behalf. Once we've done these things, you can see that if you were looking at the end of the month accounting, and these were the only intercompany transactions between the two companies, in orange, Exotic Key intercompany receivable and ECI intercompany payable, they have to be the same amount. So if this commission was $1,000, you should have an intercompany receivable in ECI for $1,000, and then you should have a payable in Exotic Key for $1,000. So these intercompany accounts always have to balance. So now let's look at example 2, where GBO has a credit card machine, so gets a deposit on behalf of GBB. So on the left, we have GBO's accounting, and on the right, we have GBB's. So for GBO, all they're doing is receiving the cash. So they could prepare an invoice, but in that case, it does not go to revenue. Instead, you could see in the entry, we debit accounts receivable, but we credit GBB intercompany payable rather than revenue like we do on the GBB side. Then when we receive the payment, we're debiting bank merchant deposit because it goes into the bank account at GBO, and we credit AR, so it's out of the system. Now, other options we can do here, if the customer comes in and makes the credit card payment, you could simply do it as a cash deposit where you code that to GBB intercompany payable. So there's no problem with doing that at all. On the GBB side, though, you do need to do the invoice because that customer is in GBB and you want to track all your customers along with the associated revenues in the company that it belongs to. So for GBB, we do our normal invoice, debit, AR, and credit revenue, but we don't record the receipt because it's not a receipt in that company. It was already received in the other one. So our credit that we do against that invoice in GBB is debit, GBO, intercompany receivable, and credit AR. So that basically results in the same type of example that we had in number 1, where we have a payable and a receivable intercompany-wise that balances at the end of the month. Before I move on to example 3, I want to briefly cover the consolidation procedures for these intercompany balances. I already said that each intercompany needs to balance, so you have one company with a receivable and the other with a payable. And then when you're preparing the consolidation, you actually need to eliminate the intercompany balances. So if company 1 has a $1,000 receivable, company 2 has a $1,000 payable, basically you do a journal entry to back both of those out, not in each individual company, of course, but in a consolidated entity file. And the consolidation, I'll talk a little more about how that works and how companies sometimes do it, but here just note that they need to balance and on consolidation need to be eliminated. Example 3 is where GBO is charging rent to SPC. Now, in this case, there is no payment necessarily made between the companies, although there could be, but in this case, there isn't. So in GBO, we're going to prepare the bill because we have an expense. It's debiting rent expense, and of course, when you prepare a bill, it goes to accounts payable. Then, because there's no payment physically made, we do a credit where we debit accounts payable and we credit SPC intercompany payable. GBO owes money to SPC for the rent. On SPC's side, they do a sales invoice because they need to record the rent revenue. So you can see we debit AR and credit rent revenue. Then also, we have to do a credit, right? Because again, they're not receiving any money. So on the credit, they are getting it out of AR, but they need to debit GBO intercompany receivables. So in both cases here, we have those intercompany receivables and payables that balance. The reason I did example 3 is that there isn't an extra elimination entry required here. So just like in examples 1 and 2, we have to eliminate the intercompany balances when we're doing our consolidation. But in addition to that, any intercompany revenues and expenses also need to be eliminated. And sometimes when you have sales with markups, it's more complex, and I'm not going to go into that in this case. But with our example, just because it was a rent expense and a rent revenue, those are very simple. Basically, what you're doing is getting rid of both of those balances, and they are not included in the consolidated financial statements. Example 4 is where we're receiving money from customers at GBO via credit card for SBC gym fees. So on GBO's side, we have that payment made at the front desk, and we're going to record that as a cash deposit. We're not going to do an invoice because we don't want to have all those customers in GBO because they really are customers of SBC. So all we do there at GBO is debit bank to merchant deposit, and instead of crediting revenue, of course, we credit the SBC intercompany payable. Then on SBC side, we do our regular invoice to record revenue, so we're debiting accounts receivable, crediting gym fees revenue in this case. But of course, we can't do a receipt in SBC since the money was received in GBO, so we do a credit memo. And that credit memo gets coded to GBO intercompany receivable. And so, of course, our AR is now zero, and we're left with the gym fees revenue in SBC. And then, of course, in GBO, we have the bank side. So the intercompanies again balance. The other thing I want to talk about, since this is the last example, is how you process intercompany transactions. So on GBO side, because they're getting all of these credit card payments in, likely that's the first indication that some accounting needs to be done. So GBO's side is done, and then we need to figure out how we notify whoever's doing the bookkeeping for SBC. So in a lot of companies, they're done by different people. If you're able to do both yourself, obviously do these at the same time so you don't do GBO side and forget about SBC side. So I'm going to get a little bit more into software brief in just a couple minutes here, but if you had the right software and you had a payment in GBO to intercompany, you might think, well, why can't it just give a notification to someone in SBC to do the actual intercompany? And that's what I'm going to talk about next. Now I want to talk about accounting software. So in many systems, when you do an intercompany entry, as long as you link the companies, the transaction will be sent to the other company for coding. And that's the most efficient because you see cash in one company or you see a payment in a company, and obviously the other company needs to record it because you picked intercompany. So automation is really good for this because otherwise you could forget one side. Now this could work in QuickBooks for some companies, but in our case it doesn't because we're using multi-currency accounting. So unfortunately, even though QuickBooks can use multi-currency and it can do the intercompany setup correctly, it doesn't allow both to be done in one system. So unfortunately for us, we do actually have to go into both companies separately and record the transactions the way I was showing. The other thing about QuickBooks I wanted to mention is as soon as you're doing multi-currency, there are times you cannot do payroll. So if we have a home currency of Belize dollars, basically anything other than US dollars, that means we're not allowed to do payroll. So that's another thing to consider when you're choosing your accounting software. So I caution you that when you are setting up your company initially, try to think through the types of things you might be doing in the future before picking your accounting software. In conclusion, I just wanted to give a few reminders. So number one, ensure all your intercompany accounts balance each month. The longer you go without doing this, the more complicated it becomes to find what's missing. Then when you're doing consolidation, how do you do it? Well, many companies use Excel for their elimination entries. There are more comprehensive accounting systems that will allow you to have a consolidation entity that brings in all the other companies and has the ability to record elimination. But if you're using more simple software, usually companies download all of their statements into Excel and then record the elimination entries to get their consolidation. The other comment I wanted to make sure that I mentioned is that ensure that you are doing bank reconciliations every month because that will ensure you find any missing transactions. So if you wait to do bank recs and you try to go back 6 months, for example, you'll get a receipt in and you may not know where it related to, especially in the case where you have a lot of intercompany transactions. So I hope this presentation has helped you understand how intercompany transactions work. And if you have any questions, please reach out.